Well, hey, we're going to get kicked off now, and thanks everyone for joining on in Brisbane, it's a rainy Thursday afternoon. And I guess the topic we're going to run through is getting a business ready for sale. It's a topic that has come up quite a few times and almost like more and more over the last sort of 2 years. We're actively usually working on sort of two or three of these projects at any one time. A lot of our clients are also asking about the topic too. So we thought, why not do a webinar on the ins and the outs and all the things to consider when it comes to selling your business. I will be co-presenting with Riz in our team.
Hello.
He is just in there, just joined us now. But I'll do a quick intro and mention a few things before we get started. So this is a photo of our lovely team and an introduction to our team at Inspire. We've helped our clients save over 22 mil in tax and counting, and picked up quite a few awards over the last, in the last year. It's been pretty cool. And what I also want to do is, if you're keen to talk to one of our accountants about what we chat through today about selling a business or that sort of thing, then the next step, if you're not a client, is to book a strategy call with one of our accounting team. Tay from our team has just popped the link in the chat box there, if you're interested, and you can sort of debrief if the topic of concern or of what we're about to chat about is something you'd like to debrief, or just general accounting questions, feel free to book that in. Also, a bit of a shout out for a book I published just about 2.5 months ago now, which was Wealth for Life. If you do want a copy of that, the link should be in the chat box. Yes, there it goes. Thanks, Tay, for posting that link. You can buy that at our website. But that is a book I wrote over the last couple of years called Wealth for Life, and it outlines the 9 steps business owners should follow to create wealth for their family. There's heaps of practical steps in there and activities to do. Especially with your spouse as well, to make sure you're on the same page and grow your family's wealth. In terms of an introduction to me, if you don't know who I am, my name is Ben Walker. I started Inspire when I was 23 years old. I'm an award-winning chartered accountant, and I just mentioned then the author of Wealth for Life. And these are some pictures of my beautiful family. And we've just actually had our third baby about 2 months ago now, called Poppy, our third baby. So we've also got Riz here. Riz, would you like to give yourself a bit of an intro?
Thanks, Ben. I hope the audio is coming through okay.
It is, yes.
Excellent. Just nice to meet everyone. If you've never seen one of our webinars, I usually co-present this with Ben. And funny enough, today I think we're wearing the same shirt. That does happen from time to time. But yeah, my name's Riz, and I'm blessed enough to be working with Inspire, and I've been working for Inspire for over, I think, coming up to 7 years now. I'm the associate partner, general manager, and proud enough to also call myself a chartered accountant. And I've been working in accounting for a while now, and previously did work with some of the businesses in Brisbane, being one of the in-house accountants as well. We're really proud to say that we've been able to save our clients up to $2 million in tax and counting, and for just our clients, my clients itself. Inspire's done a little bit more than that, but it also means we've given away at least 2 million days of help for families in need across the world. And on the next slide, it's actually been quite an interesting last 7 days for me. That's my wife, Fiona, and as you can see in that little cute photo, there's shoes there because we were expecting a baby boy. He was supposed to come in December, but he came last Monday, so it's a little bit early. I'm starting to understand what working on no sleep feels like as well. So do pardon me if I mix my words a little bit today, but it's all very exciting news, and it's one of my big passions is to be able to help families, especially young families that are growing and trying to navigate through their lives, both personal and business, because I really believe that business can really change the lives of the families that we work with. But yeah, that's a little bit about me.
Awesome. Thanks, Riz. And just a bit of an overview on what we're going to cover today. It's going to, we've got a lot of detail to cover, and some, we'll call on some of our experiences, but also do want to encourage people to ask questions as we go. But we're going to start off with some high-level things to consider, what the buyer is going to want to know as well. So that's like the non-financial stuff. But then also, we share what the buyer would want to see from a financial perspective. And then also we've got a conversation around how much tax that you'll often pay. And we've got some examples of concessions and exemptions for business sales, which are kind of cool because, I don't think business owners realize enough that a sale can actually be quite a considerable portion or even the whole thing as tax free. So that is the menu for today. Before we get into it, though, I thought it's probably worth mentioning a few things. As I was putting these slides together, I feel like, what we're doing is sharing a good amount of context, but every person's situation is different. Every business sale is different. So I really, I can't sort of do this without saying get detailed advice before you're looking to sell or as you're looking to sell and also during the sales process. So it's actually quite an intense process from the moment that you sort of agree with a buyer, high level terms right through to the actual settlement when the keys are handed over, so to speak. In that is, a team, like a really crucial team of yourself as the business owner. You need a really good lawyer who's actually experienced in M&A or mergers and acquisitions. We can't, ideally, you don't want to be using a lawyer who hasn't had that experience and is dealing with that with, a fair bit of what they do commercially. Also, your accountant, same thing. You need an accountant with experience in this stuff because if they start sending wrong information or too much information or not enough, you could freak the buyer out for a number of reasons. So this is a team that works together. They all need to get on as well and work together. And I just feel like DIY is disaster with this stuff. So, if you get the accounting wrong, the tax outcome could be worse for you. From a legal perspective, you could be exposing yourself for too much risk, especially if this is your first sale and you don't know what to look out for from a risk perspective, you could put your foot in it massively with that stuff. So, there's definitely some, like, before we get into anything, that's what I would recommend to keep in mind. Riz, do you want to?
Yeah. Naked, just to add a little bit more from what Ben said about the lawyers or the M&A side of things, there's usually quite a lot of back and forth as well. And what you normally expect from a team perspective is your buyer will also have a team on their side as well that you probably deal with as well. So what you don't want is in a meeting and you're sitting there with 3 different people who are experts in this area sitting across you and you're not having that support. It's not a nice place to be, especially when you're going through something quite big like selling your business, right? So get that team right at the start, super important. And if you're planning to sell it in 6 to 12 months, I'd say start collecting that team and giving them a heads up now rather than, give them a call on the day, because there might be some stuff that you want to discuss beforehand.
And just to add that we don't want to know about the transaction after you've signed something either.
No, for sure. The more lead heads up we get, the better it is. Now, there's a few things that you want to consider when you sell. Now, first of all, it's who. That's important to understand. It's not like an owl and adding that. Who. First thing is you can sell it to obviously when you're selling it from yourself to someone else, a third party, and someone who's totally not related to you. So you're pretty arm's length. Now, when you consider who you're selling to, there might be different approaches to each one of these as well. Because if you're selling it to third party, to total stranger, they don't really know much about your business. And they probably will ask more questions as well. Because if you think about selling in a business or buying a business, you probably want to try to dig deep into the numbers and the reasons why as well, which we'll go through in a bit. The next one also is you can sell to a competitor. And that's usually through kind of because the competitor wants to grow, grab more market share in the industry. And we've seen this very typical, especially in professional services or even in allied health. They buy kind of like books of clients from each other. So that's not a bad thing either. Not saying that you lose to your competitor or anything like that. It just means that they might want to grow and your timing is you might want to exit. So that's usually a normal part of an exit transaction as well. The last one's quite an interesting one, management buyout. When we talk about management buyout is you're essentially wanting to hand over the business to someone internal in your business. It's a cool thing to do as well because they know your business, they run it day to day, they know the ins and outs, and there's probably less relationship handover that you need to do as well, where it's someone who's a third party or a competitor, you might end up losing some either team members or clients or anything like that, where you sell it to an internal team member. It's an easier conversation usually, and they probably know your numbers anyways, so you probably get to an agreed amount fairly quickly as well. So yeah, and the next thing we want to consider as well is how much thank you, Ben. How much will you sell the business? When we say how much is not dollars amount, it's kind of like the parts of the business, because you don't have to sell all of it. Typically when you're selling it to third party, you really kind of walk away from the business as well. You kind of sell all of it, but you don't have to. When you sell to someone who's in management, or when you're one of your team members who wants to take over the business, you can also sell it in small parts. The reason why you would do this is also to help. You have to understand that the willing buyer needs to also be financially stable enough to take that purchase from you. So they need to have enough money, capital. They need to be able to borrow if it's on finance as well. So what you can actually do is slowly transition your business over to a team member as well. So you can do it over time, so that you effectively having some sort of succession plan as well, and also they can effectively start building profits from the business to then use to buy the next lot and the next lot, and so on and so forth. So it's interesting that some people don't always think, oh, if I sell all of it. Not necessarily. So there is an option there as well. Next is what will be sold. So this is an important distinction in the M&A world, because typically you can sell either the shares in a company or a unit in the unit trust, or you can sell the assets of the business. So the analogy I use is, do you sell the house and the contents together, or do you just sell the contents itself? That's kind of the analogy. When you sell the shares, you're selling the company. I'll just use company as the example here. It applies to the unit trust as well, but you sell the company as a whole. So it means that the name of that company, XYZ Pty Ltd, that whole entity actually moves to a different owner. But having said that, the difference there is you're not moving any assets out. You're not moving any of your plant, equipment, stock, cash. You're not moving it out of the entity. It's the shares is the one that you're selling. So a key difference there is you have to understand who your shareholder is, because that will make a big difference from a tax perspective as well, because the shareholder is the one that's going to make that capital gain. We'll talk about that later. So who sells that share is important. Now, sometimes you don't really have a choice. Sometimes the buyer prefers an asset purchase or sale rather than a share sale instead. Oop. Eating my lunch, live it. But yeah, so you got the sometimes you don't have a choice. Sometimes the buyer just wants an asset sale, and typically what they would do that is they don't want any link to the company, a historical company, since the day it was started up. They just want the meat and the potatoes of the business, and just really take the contents of it, and then they can make money in their own entity through the purchase. So those assets that we talk about, I talked about plant, equipment, stock, inventory, but the big part of it is you're probably selling what we call goodwill. So goodwill is something that you don't typically see on your balance sheet unless you've done some revaluations. But essentially, it's the other parts of the business that has to be valued. So this typically comes from, and we'll talk about this as well, is the ability for you to calculate what we call future maintainable earnings. We'll get to that in a second. Yeah, so the last dot point there about selling either the trading entity while retaining IP or equipment or commercial premises is you might have a structure where you've split up some of these assets into different entities. So typical stuff that we've seen is you put a plant equipment in one entity, you actually assign IP, your intellectual property, into another entity, and then you have a main trading entity that's running the business. Now you could actually sell them separately as well. So it's very important to understand what the buyer wants and what do they value and what are you trying to sell. Because if you sold just the, let's say, plant and equipment, that's a bit weird. But if you just sold the business itself, you could retain the IP and you still could earn some income from the use of that IP as well. So there's things like that that you can do. Again, it depends on how big and complex the sale transaction itself looks like.
Perfect. All righty. We'll run through this next bit here. So I guess in terms of the next question I popped down was like, how much do you want? So, and this is often a bit of a difficult conversation to have maybe with yourself. But I guess overall is what you're offering or asking for a fair price? Is it too much? Like you might value your own business too high or have the perspective in your head, hey, I need this amount of number. Like it must be like $2 million. Anything less and I can't, accept that. Regardless of what valuation methods suggest it might be. So I think you might be sort of shooting yourself in the foot if you're like hanging on to a number in particular, but also not enough. Like sometimes we're too close to our own business. We're not aware of the value that it holds. I think that one's probably less common than people expecting it's worth too much. But definitely I think, the process of working this out is to actually get a valuation, understand valuation methodologies and obviously what something's worth is what someone's willing to pay for it as well. So, we've got to keep that in mind. But in terms of what we've seen work the best for buyer and seller and the transaction is actually just a fair price. So what is a fair price for this? And the next question is here, well, how do we work that out? How do we value that? Now, the most common method of valuation is to get this thing called EBIT, or earnings before interest and tax. And we times that by a business multiple. Now, that business multiple is very dependent on the risks in the business, the industry, the tenure, all these things kind of come back to risk, but the multiple is really like a reflection of the risk in that business overall. So like an example of that is if we have a, let's say a $500,000 profit and our multiple is 3, then that business might be worth $1.5 million. Now, there's other things in terms of value we need to consider, depending on how the transaction's going. Like if we're selling the entity, then we've also got a balance sheet or maybe other assets that might go with the business to value as well. So we've got to keep that in mind. Some industries or businesses might have a rule of thumb method of valuation. I was speaking to a mortgage broker as an example the other day. And one of their other mates who's a mortgage broker has just sold their business for their revenue or their trail book times by 2.5. So if they've got 300 grand in, hang on, I'll pick an easy number, $1 million in their trail book, we times it by 2.5. That's 2.5 million sale value. There's only there's less businesses that would be valued on the rule of thumb method in general than this EBIT method. And then other agreed value or process, again, if we're not selling a complete standalone running functioning business, we might be buying a customer list or, we might buy a portion of clients or, other assets. We might just agree to a value or there's some other process, but I guess in order, this is sort of what mostly we see.
And I've seen people. If anyone's seen Shark Tank, that's another method of valuation. Actually, it's reversed from what they need. So a lot of startups use that. So the EBIT and multiple, we're looking at more mature businesses. Some startups might go, I need 100 grand just because I need to do marketing and things like that. So they reverse that backwards and say, hey, for 100 grand, you get 20%. So literally they're valuing their business by what they need in cash because they're raising capital. So that's not necessarily selling your business. That's kind of like the raising capital activity. You could value it that way as well. Again, not typical of mature businesses because you're probably not that desperate. You're probably looking for someone to to buy it at a good value. So there's other ways to do that. And I think the most important thing is understanding that it's what market value of a business is actually the price that ends up on the contract at the end of the day.
Absolutely. And one of the things we recommend to people considering selling is go through the valuation process to get that reality check of what a third party, and that could be us, what we reckon your business is worth. And then if it's a good amount, if you're happy with that, great. You might want to go to actively sell it. But if you're not happy with that and you understand the drivers of what's going to increase your valuation as a result of going through that process, then you can actively work on that. We've also had clients do that process. They've gone, oh, well, okay, that's probably not what I wanted, but let's do, work hard for the next 18 months to 2 years to get that valuation up to what we are keen for. The other thing to consider as well is what terms are you going to sell under? Is there going to be an earn-out agreement on that? So does that mean you're going to have to, delay when you're going to get your cash? You might get 60, 70, 80% up front and then a balance after a certain amount of time. Earn-outs, we commonly also see a period where the owner has to work for the business after the sale as well. So they don't just sort of get their cash and run. They've got to, do a year or two or sometimes 3 working for the buyer and continuing to run that business while the transition happens. Another one is like a non-compete. You might be discussing with the buyer around that sort of stuff. And then warranties and indemnities. So what we're sort of talking about there is, if you're a buyer might want you to indemnify them against, like let's say you've stuffed something up in the past and that comes back to bite the buyer, there might be an indemnity or a warranty that you give them to say that, if something bad happens like that, you'll cover the cost, or that'll come off the price, like the delayed payment, so to speak. So that we kind of see those are quite common, especially with the more warranties and indemnities that you'll often have, is the more risk that might be associated that comes later. For instance, financial stuff, or a problem might not be picked up immediately; it might be picked up a year or two later for like accounting or legal or something like that. And again, we want to make sure there's things in place that deal with that for the buyer and protect the buyer.
And this is where lawyer comes in. The T&Cs are so important, and this is where the lawyer really kind of earns their money as well, because sometimes it's heavy-handed. Depends on what kind of transaction and what industry. There are some kind of general guides of typical T&Cs that we see, but sometimes it's heavily weighted towards the buyer, and that's a reason why. And you want to sell it, sometimes you can't get away with it, you have to agree to it. But the lawyers actually work out what's a fair and equitable condition. With the earn-out agreement, I just want to add as well, typically what we've seen as well, if it's a particularly big transaction and they want some sort of kind of clawback, they can sell it for, let's say, $6 million for that business, but we'll pay 3 now, 3 later, depending on the performance when you work in the business. So you'll still have to kind of keep the business running in a high performance level for the next 3 years, and you actually get that extra 3 million. They even sometimes build in bonuses. If you do more than what was expected, then you actually get more in price as well. So there's no set way with the T&C, but there are some generally accepted terms that will be included. That's why the M&A lawyers are super important for you to get involved in.
Absolutely. Rick?
Yeah, and I kind of touched on this a little bit, like with the earn-out agreement. What does life look like after? Before we kind of think about what your life looks like after, you obviously want to get to the point where you already know this before you sell, because as business owners, depends on how long you've run a business. If it's a big part of your life, if it's for retirement, obviously, maybe going fishing and trips, but you might have some passive income strategies that you want to put in place as well, because you want to stop working, and that's the objective. Now, if it's to sell, then to get back into it and buy another business or start another venture, I would think about that as well, because usually it's very interlinked. When you sell a business, you have an X amount that you're thinking of. Now, there's no point having that money just sitting in your bank. by way of just inflation we're seeing right now, you're actually not earning, you're actually going to lose some money over time. So what's actually your end objective after that? It might be passive income, it might be put into super, it might be things like that. That's cool. All we're saying is have a think about what life looks like after. Now, lifestyle as well is also important to understand. Are you actually going to still work for the buyer, or are you going to retire? Are you going to sit by the beach, have some cocktails, and hang out with your partner, and sail into the sunset? Also, in terms of what to do with the cash, we talk about retirement. I think, Benny, you shared this in the past. You'll never have a point where you won't be doing anything. You won't just sit there and do nothing because you love what you do. So I've seen that resonate a lot with many business owners. That's why they are in business. They want to add something to the world as long as they have the energy to do so. You probably want to think about, is it enough to semi-retire? So you have this, you just focus on the 2 days of the week doing what you absolutely love and using that extra cash or capital that you got from the sale to fund that, which might return your income as well. But the other part of it is you need to have a really robust investment strategy, whether it's properties, shares, other passive type of income as well. What usually happens sometimes is, you sell a business, you go, now what? You don't want to end up at that point as well. You want to have a bit of a plan, even if it's not super clear, have a general idea. And it's also important to understand what the tax effect after that as well, because if you're thinking you're going to sell it for $1 million, you're going to get $1 million, unless you're really applying some of the concessions heavily, you need to really understand that you might not walk away with $1 million. And if you thought you're going to retire because you have $1 million, actually the tax is going to take 300 grand away from that. That changes your timeline of retirement. So really try to understand the full journey of that transaction, from kind of expression of interest all the way to settlement, and what to do the cash after as well.
Yeah. All righty. Well, now we're going to change gears into what do buyers want to know. And I guess what we call the buyer learning process is the buyer doing their own due diligence. And I've given some example questions on this slide and the next slide. There are a lot here to cover. So what I'm going to do is sort of read through them. Any sort of key things I want to talk about, I'll mention that. And the other thing is these are the common questions, but definitely not all of them. So you might get some left field questions depending on the business, the industry, what's going on, the appetite of your buyer, how experienced they are as well. Like, do they do this? Some people are just, they've got acquisition teams within their business, and they'll just, go through like a fine tooth comb. So anyway, all right. So first thing is, like, why is the business for sale? What's your motivation? Is it a desperate sale, or is it something that, if the right buyer comes along, they're all going to impact the buyer. What is for sale? So we spoke about that earlier. Is it all or part of it? Only certain assets? Even is it shares or goodwill? That question comes up. Who are your key customers? Who are your key team? And I guess what they're looking for there is around, how are they going to manage the relationships going forward? Any conflicts of interest? A key team going to stay around? That's important, and that actually might be a term of the contract. If there's actually key team members, it relies on them staying, not taking off. Can the business run without you? Otherwise, what skills or roles are needed to replace you? What are the future maintainable earnings? And this is, a really obvious question from a valuation perspective. So what does the buyer expect they're going to earn once they pay money for your business into the future? What's your current sales and what's the future capability? So what's, things around your internal capacity, or what's the industry doing in general? Again, the buyer's going to want to know that. Can the current client and supplier relationships be continued under the new ownership? Things like, are there going to be a handful of clients that are going to move wherever you move afterwards? Same with suppliers. We've seen the suppliers have long agreements based on relationship. Is that going to continue with a new buyer? And as a seller, you've kind of got to be aware that there's a lot up to the buyer as well. Like, if they go and they don't have the same relationship that you had with your clients and suppliers, then that's on them to a degree. And you've got to make sure your legals support a fair wording around that. for businesses that are equipment heavy, you might need to consider, does the buyer need to replace any equipment soon? So, do they need to spend 300 grand on, manufacturing equipment because your stuff's about towards the end of its effective life? What's your current lease terms? Does the buyer need to take that lease out, or do you need to negotiate your way out of that lease after the sale or as part of the sale? Here's one thing they're going to ask or feel. Is the seller being open, transparent, and helpful in supplying information, or are they guarding information? And I don't mean that we should willy-nilly supply the buyer anything they want instantly and without review. We need to make sure what we're sending them is reasonable, timely, to help them through their due diligence process. Does the legal agreements match the conversations? So usually what would happen is you agree to like a heads of agreement, or I think there's another term that can be used for it, but you have that initial agreement to say, here's the high level, what we're looking to achieve with this purchase. And then you go through the due diligence process to then get to final contracts, sign the contract. And then again, there's usually a difference between that and the settlement period as well. So we want to make sure that the legal agreements have actually matched that process, and involving the lawyers at every step. What are the relationships with related parties? So again, if we've got like, clients who are family, or suppliers that are, mates for 20 years, maybe you're the landlord. Like, how does that look for the buyer post-sale? If you're the landlord, are you going to boot them out? Or when does the lease agreement run out? And we've actually seen the buyer want to sign secure leases for 5-10 years after the sale because of the cost of moving the business if the landlord was to boot them. In general, what are the risks? So that's a really very open question, and it'll often come to you a bit more detailed than that, or a bit more specific, but yeah. Including what are the risks of the entity they're buying if they're buying the shares or the units in a company or trust, because they're inheriting the previous things that you've done. And again, that's where warranties or indemnities might come into play. Ooh, a few there.
And I guess that's a good segue to this, right? Like, there's a lot. And I think when it comes to due diligence, right, like, to be honest, it's whatever they want to ask, because they're about to buy this business, and what they see, they're probably going to, whatever that triggers them. Now, the typical stuff we do see, and this is a typical things, is the list here. So this is really around the financial side of things, and because that's going to give them a good initial lay of the landscape when they ask for this stuff. So obviously they're going to ask you if you have a valuation of the price. They want to see what supporting documents are behind that. So in our process, when we do our valuations, we actually spit out quite a big report on how we arrive to the future maintainable earnings, and also how we arrive to that multiple as well. And we also benchmark that against any other businesses that might have been valued in the industry as well. So the stronger that you have that valuation support in front of you, you kind of have a really strong leg to stand on, right? You go, hey, look, this is pretty robust. It's not based on a number plucked out of thin air as well. And also, that's the second point, right? Obviously, the future maintainable earnings. So to do that, they want to look at the profit and loss and what add backs that are included in there. So when we think about add backs, it's basically non-operating expenses or income that they are not going to, that doesn't have any, that are not commercial value. Some very typical things is if you don't have a salary, because you might run your business through a trust, you might add or take away, include a salary as well in there. And also there might be other things, like if you had excessive depreciation that year, you want to adjust that down to actual commercial value depreciation. And also the typical things like interest and tax, because future maintainable earnings is earnings before interest and tax. So there's things like that. They'll ask for your normal month-to-month or year profit and loss, and different buyers have different capabilities to analyze some of this stuff. Some of the more institutional buyers, they have teams like Ben said, and they have some ratios that they want to run as well to make sure that the business is actually turning over a good amount of profit for the effort. Zero access, yeah, typically we give read only so that they can't change and take information with them. They can have a look. BAS's tax returns just to make sure that you're complying as well, but also to understand what the tax environment for this entity looks like as well. Your financial statements prepared yearly by your accountants, and also any detailed supporting documentation. So things like lease agreements or if you have a value of a big value of asset, and that's a big part of the balance sheet that they are going to buy, they want to see maybe how often it was used, what's the effective life, things like that. Now, when it comes to employees, especially with team heavy, things like consultants or agencies that use people instead of using equipment to produce the income, they're going to want to understand what the employee environment looks like. Who are people that have quite big leave balances, because that's a liability that they usually undertake. I should say as well that they usually put a clause in the T&C as well if someone leaves and they have to pay out leave because the team member has exited the business after the sale. There's actually a bit of a penalty to the sale, the purchase price as well. So there's things like that they include in the terms and conditions. They also want to see the tenure of employees, right? So if employees are a big thing in the business, they want to make sure that you don't have a high turnaround as well, because then that signifies management capability as well, or any issues. So this gives them quite a high level, and they might dive deeper to specific questions. But this is where your accountant and your lawyers come into play, because we have that information at hand. And again, what Ben said, we don't just send it across. You want to make sure that you present your best foot forward. It's not about hiding things. It's not about lying. We're not for that, obviously. It's about providing the context that they might not have when you look at it at face value. So when you look at it and you don't have the story behind it, they could be misconstrued for something else. And usually that's quite a civil process. It's not like you're shouting and screaming or anything like that. It's just a bit of a note. Hey, this is actually why some of this stuff, you're gonna proactively mention this stuff to them. And my advice is, if there's something that is obvious that's going to be an issue that your buyer is going to care about, you want to be super upfront about that at the outset, so that it's not a surprise, because surprises kills deals. That really does happen when you see some of these big deals, they're about to come to the end, and there's this one thing you left under the rug you were trying to hide, and they find out. If that was said up front, maybe it would have been dealt with a lot better. And you don't want to lose a deal just because you're hiding stuff. So if you have a team, talk to them about it. Hey, I'm worried about, if you're talking about team members or anything like that, or I'm worried about this stuff. How do we actually present this to the buyer? ATO history, that's pretty normal. You just want to make sure that you're not in trouble with the ATO. Some other stuff that's not in here that I've seen typical as well, what I like to call key contracts or significant contracts that you might have entered into. So lease is one of them. Supplier contracts, that's a key one if you're buying supplies. Either you have exclusive rights over something, will that pass over, things like that. If you have key contracts, it's also important that you have that quite organized. The quicker that you supply this stuff, usually the better for the transaction, because you delay, you're trying to find it, I can't remember. So being organized with some of this stuff at hand before you sell helps massively with the transaction as well.
All righty. Well, now we're going to shift gears to the tax side of things. And we've kind of got a couple of things to cover. So we've got what we've done here is basically walked through what are some examples of outcomes when it comes to the concessions and exemptions that you were eligible for in a business sale. So I guess, first of all, it's good to mention that the business sales are capital gains. So it's not like they're treated as like a revenue or you pay tax on every dollar. Necessarily. And it very much depends on how it's sold, which again, this is important why accountants and lawyers are engaged at the start early. There are a number of concessions or exemptions. So the high level sort of way we'd look at it is there's a general 50% discount, not eligible for companies, but if the thing selling the asset is a trust or an individual, we get this 50% discount, and then the small business concessions. Now, with the 50% general discount, it's the business needs to be run for over 12 months, by the seller, and generally the 50% discount is on the straight up sale amount. So I'll get to the example in a sec. The remaining balance, so the remaining 50% is taxed at that entity's tax rates. It's not available for selling assets from companies, which I mentioned just then, but it could apply to selling the shares in the company. So if the shares are held by a trust or an individual, and held over for 12 months, then we're all good to go there. An example is if you've got $1 million sale amount, we upfront halve it due to this discount, and then we're only paying tax on a net gain of $500,000. And I've given the top marginal tax rate here. So we're looking at $235K in tax under this one here. So yeah, we're left with just over $750K. Now, if you're a company, you don't get a discount, but the tax rate is less. So on the same $1 million sale value, we're looking at $250K in tax. And really, those amounts are quite small, the 15 grand difference when you compare it to the $1 million sale amount. So I wouldn't be sort of too caught up on if it's in a company, you don't get a discount. Really, it needs to be contextual like that.
Yeah, and I might just quickly add there, Ben. Something that's worth mentioning is some of our clients, they're selling businesses that they bought originally, they didn't start up from the ground. So when you buy a business originally, you would have had what we call a cost base. So it's the capital gain is only on the difference of the sale and what you purchased it for at the time. So it's not on the full amount as well. That's just worth mentioning if you did buy it. And it's to understand how much you paid for it first. Kind of like the capital gains you would calculate on selling a house, not too dissimilar. The other thing I just add there is just quickly, if you sold the assets of the company, something that needs to be clear is that the company made the capital gains. So understand that the company is the one that's making the money, not you personally. So if you were planning to use it for retirement, there needs to be another subsequent planning session for you to be able to draw some of that money out of the company, because how you draw it is also important. The company pays the tax, has all this franking credits in it, cool. But if you just pull it out in all out, you might, pay quite a bit of tax. So the planning after that is also important. That's where I was saying before, if you have an idea of how you're going to sell it, make sure you understand what you're going to do with it at the end as well, because the tax impact is different at every stage. Cool. And then the next bit is on the next slide there, Benny, is the small business CGT concession. So it's basically the ATO giving small businesses a bit of a break when it comes to capital gains. Now, this is not limited to only business sale, but if there's any capital gains that's made in a small business, you'll be able to access some of this. Obviously, you have to pass some eligibility requirements first. So one of them, this is not detailed. It's actually quite a complex undertaking because there's a lot of tests that you need to pass as well. The easiest one to pass usually is you run a business, obviously, and then you have a turnover of less than $2 million. Now, I haven't seen many unless it's internal sales that happens below 2 mil, because usually, when we're talking about business exits, it's quite a mature business over time and they have about a turnover more than 2 mil. So I kind of argue what's the point here a little bit, but if you are under 2 mil, great, you tick that box, right? More often than not, it's actually the second dot point that we have to pass, which is you need to make sure that you have net assets of less than $6 million. Now, sounds very simple, right? Oh, yeah, $6 million. It's actually quite more broad than that. It's not just the entity that you're trying to sell or the business. There's actually other entities that might get pulled in there as well. And it tests all assets, all CGT assets. So if you're connected to the business or you are an affiliate of the business, I'm going into a bit technical text here, but your assets are also taken into account. However, it does exclude personal use assets, things like your home and also your super balance as well. It's interesting because some people say, oh, well, I have a house, but all there's no equity in it. There's some things that you can do to shift money across before the sale to make sure that you drop the value of your net asset as well. Because if you pay off your home loan, for instance, then you're putting more money into something that's excluded. So you can do things like that. Again, I'm saying this again and again because it's important. If we get this clear picture 6 months out before you sell, we have plans to make sure that your tax is also quite low before you do sell the business. Because getting this, and I'll tell you what the concessions are, getting this access to this concession means a big difference in terms of tax. And if Ben, you could share the next one. Oh, I should mention, if you're selling a share or unit in a trust, instead of selling the assets itself, there are additional conditions. I'm not go through that in detail today, but it's not too far off from the original concession eligibility requirements there. Now, the 4 small business concessions, CGT concessions, it's listed there. Number 1 is what we call a 15-year exemption. Now, essentially, this just means that if you've run the business and owned the business for more than 15 years, and I think you have to be 55, men.
These are just the 4, and then on the subsequent slides, I've got the detail.
Awesome, thank you. So we'll go into detail after this, but there's 15-year exemption, which is, it basically makes it tax-free, and then there's 50% active asset reduction as well, and which is that 50% discount. And then there's also the small business retirement exemption and the small business rollover. We'll go in detail in the next slide. What you don't see here is that general 50% discount that Ben was talking about before. This is on top of it, if you're eligible for it as well. So.
And the other thing as well with these ones is you first apply that 50% general discount, and then you can apply these on top of each other as well. So yeah. It's pretty cool. They're accumulative. So the 15-year exemption, we can completely ignore a capital gain if the seller is 55 years or older and retiring and has continually owned the asset for 15 years. So there's the 15-year thing. So if we've got $1 million sale, 0% tax, we're talking $0 in tax. So it's a pretty good outcome. Now, if you pass this, no point going any further with these concessions. Can't reduce it below 0. And then the 50% active asset reduction. So this further reduces the gain by 50% because of this active asset reduction. So it adds to the 12 months general discount. So how this would work is if we've got $1 million sale, we do the 50% general discount, and then we go half of that again. So for the active asset discount of $250K, which means we're paying tax on a quarter of what we sold it for, and this is the top marginal rate, that being 117.5 grand. So we're looking at about a 12% tax rate overall when we're looking at the gross gain. But that's not all we can do.
Sorry, you go.
Yeah, in the next example, because it gets so good, I've upped the example sale amount from 1 mil to 4 mil. Riz.
Awesome. Yeah, so the next example here is the small business retirement exemption. So essentially what you can do is you can ignore a capital gain of up to 500 grand in a lifetime. Now, if you're under 55 years old, you need to contribute this capital gain into your super. So the example here, I'm just going to read it out. If you have a $4 million gain, we apply some of those concessions. We're stacking it up. 50% the general discount because you own it more than 12 months, 50% active asset because it's an active asset of the business. There's $1 million net gain. That's not the tax, that's the net gain. Now, what you do then is you take 500 grand and you take off 500 grand and you essentially get tax only on the balance. So what we see there is the net gain times 47%, 235,000. Now, if you're under 55 years old, you would need to put the 500K into super. What I like about that is that 500K is not taxable in your super. It doesn't use any of your super contribution limits for the year, not even your non-concessional one. That's a whole other topic, a whole other webinar on that one. But it just means you can prop up for your retirement as well. It's pretty cool. That's why it's called a retirement exemption. Also, you can use your spouse's 500K if they're a key person in the business as well. So it's a pretty nice exemption. The only thing people don't like about this is you put money into super and you can't access it now. I think it's a great one because if in super you're going to be investing that money anyways, unless you need all of it now because you're buying a mansion or something like that. This is a great exemption that you can apply. The next one is called a small business rollover. Sounds like a trick you teach a dog, right? Rollover. But it's a small business rollover, which means you just defer the gain. Now, tax deferred is tax saved, because when we talk about time value of money, especially on big values like this, you're actually saving quite a bit of tax, or you can actually invest that money. So there's two things that you can do here. The first thing is you defer the gain by buying a replacement asset. So you made a capital gain today, you then buy a replacement asset. What happens is it rolls over, the gain gets rolled over into this new asset. So this asset needs to be a business asset, so commercial premises, investing in shares or units, or buying another business. So it needs to be basically an active asset. Now, when do you get taxed on it? It's when you sell that second asset, that replacement asset that you bought. Okay, so that doesn't have a timeline. You can sell it in 10 years, 15 years, whatever. And what I like about it, you might even get to apply some of the capital gains again, the concessions again as well. Now, the other thing that you can do is, if let's say you don't buy anything, you have 2 years to look for a replacement asset. So that's deferring that gain for 2 years. Now, how we've seen this rule being used, we like to use it regardless of whether you're planning to buy an asset or not. Because what we can do is, let's say you trigger a capital gain this financial year, 2023, the one that we're in. You don't have to pay, you don't have to pay any capital gains tax for 2023. You actually roll it over to 2024, 2025. That year when we launch that tax return, that's when we check, have you bought a replacement asset yet? No? Okay, then only we tax that capital gain. So for that 2 years remaining, you could use that money for something else. You could use that money to invest. You could use the money to create a return for you before you have to pay this tax bill. So effectively, maybe you might be able to make money to pay for the tax as well, which is pretty cool. And it is worth saying, when we talk about the date of sale, it's the contract date that you enter into as well. So be very careful, because sometimes if you're close to the end of the financial year, you might want to delay it by 1 year. That gives you an extra year. There's things like that you can do as well. And again, tax deferred is tax saved. So we like using it regardless, even if you're not going to do it. Buy a replacement asset, because then we give you at least 2 years that you put the money aside. You can put it in your offset account if you wanted to.
And let's give you the example, because this one doesn't actually have an example below it, but let's use the $4 million sale amount. Let's apply the general discount and the active asset. So we've got $1 million net gain. And imagine we're in our 40s. We don't want to chip that $1 million into super. So we use this small business rollover. Now, we don't have to buy a replacement asset that's $4 million. We only need to deal with the net gain amount. And let's say we buy we invest in another business that was 800 grand worth. We can roll over 800K and only pay tax on the 200 grand of the value. We didn't actually purchase the whole, use up that whole $1 million. So that's kind of how that small business rollover interacts with the remaining exemptions and concessions. But I mean, it's brilliant way to sort of create wealth for your family by paying a relatively low amount of income tax or tax on that. But yeah, that is the section on tax on a sale. Now, there haven't really been much questions along the way, which either means one or two things, which were pretty comprehensive, or no one understands what's going on from what we're saying. But I hope it's one of the first one. So please pop in some questions if you've got them. Talk about multiples. Oh, Darren. Okay, cool. I'll get into that in a sec. But yeah, so please pop the questions in the Q&A box or the chat box. Follow us on socials as well if you would like to see more content. Thank you, Tay, for those links. And also feel free to book in a strategy call if you think you may need a new accountant or to debrief from this webinar. Or you've got some technical questions you'd like some guidance on next steps on. But back to the Q&A. Thanks, Darren and Liz. I've got your questions there. So, Darren, I'll deal with yours first. Let's talk about multiples. Have you got any specific questions on that, or would you just like me to just go for it. But I guess, and I'll keep an eye out for your specific ones. But multiples are really based. So there's industry benchmarks for multiples, but there's also, so every accounting firm, let's say, doesn't just transact on a 3 times multiple. It depends on the business itself and the how we value a business using the software we use. There's actually an algorithm that sits behind it based on the risk of the business. So an example of an accounting firm, let's say, you might see them as low as maybe 2.5 times profit up to 5 or 6 times. Publicly listed accounting firms, there's one trading at about 20 times their multiple, but that's a publicly listed. I think we're dealing with a different kettle of fish. And actually what those publicly listed ones like doing is buying small accounting firms at 3 to 6 times multiples, and instantly their profit is added to theirs at 20 times. So that's why the publicly listed, things like Green Cross Vets or Count Plus or Kelly Partners, they're examples of 2 accounting firms that are publicly listed that have an acquisition-based model where they're instantly creating value or uplifting value from the businesses they're selling. Yeah, and in terms of a guide, like what we sort of suggest, if you have no idea what your multiple might be, is use a 3 times multiple, and you might be surprised what it could be. It might be higher. It actually might be less. The other important thing with multiples is what you're multiplying it by. So you can't. I really recommend you cannot just look at what your zero profit is. There are so many adjustments to what you times your multiple by, and if we remember back in the earlier slide, that's EBIT, or earnings before interest and tax. Now, what we need to consider is, let's say from a tax perspective, we're not paying you a salary on paper from your entity. So that's not going to be an expense you see in your profit and loss. But let's say to go and rehire you, that's going to cost 150 grand. If that's not represented in your P&L, then the problem you'll get is overthinking or overstating in your mind what the valuation is. So let's say you've got 600 grand in profit in Xero. If you go just times that by 3, you've got 1.8 mil. But what we should be doing is reducing your profit by that 150K. So you've got 450 times by 3. But there's a whole heap of other adjustments that we might do. We might even add back stuff. So, if you've got personal expenses running through the business, we'd add that back. Yeah. All righty.
I might just add there for Darren, Ben, with the business multiple or the profit multiple, there's other things. When we do it with our software and the algorithm, the first thing that we do is actually we send you a bunch of questionnaires. So it's quite subjective, Darren. That's about 60 plus questions about the industry, the risk, your succession planning, your asset protection, are you insured? There's a lot of stuff that comes into it. And what you want to be is to be scoring high on some of that stuff. Having said that, it also benchmarks against, so if you're a typical industry that has 3 to 4 multiple, it is unlikely that you'll start shooting up at the 7 and 8s because of the type of industry you're in as well. There will be a cap rate multiple improvement plan that you can put in place as well, but it is quite involved. Now, the other part that also helps the multiple is what we call the free cash flow factor. The free cash flow factor essentially, in layman terms, is how is this business turning its net after profit profit into cash? Is there a high demand on after tax profits to pay debts or to repay investors or anything like that, or is it free cash for the business owner to use whatever they want it on? Now, that has to do with the funding structure and how your working capital structure looks like, whether you have a lot of stock or you have a lot of WIP or you have a lot of debtors and creditors. Things like that plays into the free cash flow factor, because that's logical, right? Like if you buy the business, we don't want it to be does the business have a lot of ankle weight by debt that it needs to pay back rather than giving profits back to its investors. A few other things is tax rate. That's pretty straightforward. Because then you need to know what your after-tax profit looks like. The last one is cost of funds. So what we talk about there is there's a notional amount of return that's required, that's inputted in when we do your calculate your multiple using our software. That's because we understand that when they buy this business from you, they need to also be able to pay for the cost of funds they've used to buy this business from you. So typically we use the benchmark interest rate that's available in right now it's a little bit higher. So if you are able to meet the demands of the new investor as well, your multiple becomes higher. So those are a few things that actually help you increase your multiple. But again, I'd be surprised for it to go from, if the industry benchmark is around the 3s and the 4, for it to go to 8s and the 10s. I've seen different industries have different multiples. And in the tech business, I've seen in the SaaS business side of things, they have a way higher multiple as well. So it really depends. And there is a process that you can go through with this to find out what that looks like as well.
And just to sort of add for Darren's question is, what do I need to do to take a 3 times multiple to a 6? The short answer is reduce risk for your buyer. So work yourself out of the job, be in a position where you never have to show up, but the business, gives profit out the back end. Make sure you got really secure contracts in place with clients, suppliers. There's no sort of inherent risks. Reduce risk is the answer to that. And the other one to get a high multiple is, there's strategic purchases that buyers might make for where they might get a strategic outcome. So they'll pay higher than market rate. Where we sort of see this is, and I'm using accounting firms because it's just in my brain, but you might get financial planners buying accounting firms to add that capability, and then give the financial planning clients straight to the accounting firm. So they're going to get a really quick win-win there, and increase the value of the accounting firm because of their strategic benefit. Cool. All righty. So I hope that's answered that one, Darren. Liz, if I'm selling a company that the current shareholder is a trust, how would the sale be tax-free, age 55 and over? So what we do, Liz, the trust is the shareholder, but who's the person involved, or the key person in that business, and that's who we would, I guess, essentially run these tests on. Now, if it is shares in a company, there's additional requirements, but as long as if there's one owner, all those other additional requirements is to make sure that this is a key person in the business. But again, if you just recommend getting advice around that point. If there's any unsureness around that. Cool. And Peter J has asked thoughts on using a business broker, recommendations to find a good trustworthy one. We've had clients sell with and without brokers. There's sometimes specialist brokers within certain industries. Clients have had good outcomes with both. So doing it without one or doing it with them. So it's not always necessary. Where they're helpful is actually going and finding a buyer. So if you know your buyers and you can approach them directly, you may or may not need them. But again, if they're doing this day in, day out, they might be able to help you approach buyers in where use the term earlier, where you're putting your best foot forward and presenting that in a good way. If you don't have the capability or capacity to do an IM or information memorandum or some sort of pitch for your business, they can be helpful with that process as well. So again, if it all comes up to sort of what are your opportunities to sell,
sorry, man, you go.
If that's low or hard, then you might want to engage one to help with that process.
Yeah, and then to add to that, when we started this webinar, considering who you're selling to is important as well, because if you're trying to send flyers around basically to a broad base of people, a business broker might be a good addition to your team, because they'll be able to kind of send it out across to many different people. Also, if they're more likely than not, the people who go to business brokers wouldn't be the institutional experienced buyers. More often than not, from what we've seen, is the people who are targeting M&As, they have people who are doing their own research and actually coming to you directly, or you would go to them directly as well. So it depends. And it could be different outcomes as well. In my experience, what I've seen with the business brokers, they're really good at putting an IM together, and also basically keeping things moving along, because their skin's in the game as well. I think they get paid on a commission basis more often than not. And what happens is they move the transaction along. If you're too people that you know, it might not keep it moving. So there's another part of that value as well.
Cool. Hey, we're a few minutes over now, and I haven't seen any more questions come in, and so we might wrap it up, but we'll hang around for another minute or two if there are any additional questions. But thanks for everyone for joining. Appreciate it, and good to see you, Darren. Thanks for joining the webinar, mate. Thanks, Liz. Awesome. I'm going to find my 90s tunes again.
Oh, my favorite. You should really post the playlist up, man. Thanks, Stephen.
I don't know whether that was a piss take.
You obviously got a good taste. I mean, we've got the same shirt on.
Look at that. The green
Thanks,
one?
David. Sorry, man.
This is the green one, not the grey.
Oh, I can't even see probably my eyes. I shot.
Awesome.
Thanks, David. Thank you.